Good afternoon and welcome to the Thought Leadership series of the School of Business at Woodbury University in Burbank. Today we have the topic Tax Readiness in 2024 to be presented by an expert in the field, Jeff Neumeister, who is a well-educated and experienced forensic expert and consultant in accounting and financial advisory services. Small organizations, startups, holding entities, high net worth individuals, and middle market companies directly and through their retained counsel have relied upon Jeff to identify problems, uncover frauds, improve efficiencies, and to initiate and defend against litigation. Over his 22 years of professional experience, Jeff has worked in firms ranging in size from large international entities to smaller regional practices. Jeff has been designated as an expert in multiple cases and has provided valuable deposition testimony for his clients. He has provided litigation advisory services to clients spanning a breadth of industries, including construction, entertainment, healthcare, investment, information technology, and many more. Jeff has provided business valuations for litigation and non-litigation purposes. He also managed the financial due diligence process for both buy and sell transactions. Through the use of sophisticated analytic solutions, investigative techniques, and an understanding of accounting, he has found effective solutions for a range of clients' problems, including those related to tax strategies, operational efficiencies, and internal controls. Ladies and gentlemen, I now invite Mr. Jeff Neumeister to share with us his insights on tax readiness in 2024.
Thank you, John. I'm going to share my screen here, the deck I have. You should see the deck now, okay?
Yes.
Let me know.
Yes.
And also, as I go through things, if anyone has any pertinent questions about what we're talking about at the moment, you're more than welcome to chime in now. I find that tax topics tend to be very, very discussion oriented, or they lend themselves to that, right? Because there's just so many questions and personal experiences. So if it's something pertinent for what we're talking about at this very specific moment, you don't necessarily have to wait to the very end, okay? As Joe noted, I've been in the CPA world for a couple decades plus at this point. Most of my background is in forensic accounting, and I apologize for the background noise. There's a little bit of construction work at my house. They'll be done in like 5 minutes. Anyhow, with forensic accounting, some folks know what it is, some don't. Like, well, what is that, right? One of the things that comes to mind is one of those shows like CSI, right? And conceptually, it's not that different from that, except instead of bodies and blood, it's documents and numbers. So in the forensic field, an accountant ends up having to be somewhat of an expert in all areas of accounting, right? You become an expert in bookkeeping. You become an expert in payroll. You become an expert in taxes. You become an expert in internal controls, because you have to be, right? And working on a lot of these cases. And so I found that's helped me quite a bit in providing guidance for our clients when it comes to their tax planning and tax mitigation strategies and their compliance, as well as navigating them through audits. So we're going to go through a few different areas, starting with the due dates, since we are in the middle of tax season right now, and it's the end of March. Our first major set of due dates is March 15th, that we passed, and fast approaching the April 15th that most folks are aware of. Then we'll talk about a few things that can trigger or enhance someone's likelihood of being selected for an audit. A little bit about tax compliance and cryptocurrency, some strategies, and some takeaways. First, in the way of due dates, the one that most individuals are familiar with is the April 15th day. It becomes synonymous with tax day, right? Because even if someone is self-employed or works for someone else, you still have your personal taxes to deal with, right? So everyone that has US nexus or a requirement for filing in the US has to file a 1040, generally. There's very few exceptions to that. And that's usually be the 15th day of the 14th of the fourth month, every calendar year. So for this year, April 15th, 2024 is the due date for the 2023 tax season or tax year. Now, if it falls on a holiday or the weekend, it usually gets kicked forward to the next business day, right? So sometimes it's the 15th, sometimes it can be the 16th, 17th, right? But usually it's going to be April 15th, give or take. One exception to that is when there's been an emergency declaration. Case in point, California actually is giving, I believe, individuals in San Diego County and I believe in some other parts of Southern California up until I think June 15th this year for their 2023 filings because of all the storms that we've experienced, the last couple months. So if anyone resides in one of those areas, just know you have a little bit extra time to file. Okay? W-2s are required to be given to the government and as well as the recipients by January 3rd, generally speaking, January 31st. Same thing goes with 1099s. So if you're expecting a W-2, if you're employed, or a 1099, if you're self-employed, the individuals or companies that are giving those to you, you usually should get them by early February at the latest, mid-February max. If you're not, then just know that those providers are probably not complying with their own due dates. Right? If you are self-employed, there's a possibility, if you have employees, right, or if you use independent contractors, that you might need to be filing this as well as an employer. So very mindful of those with that due date for those. Now, some due dates that are common that are not on here have to do with business tax returns. S corps and partnership returns are generally due the 15th day of the third month each year. So March 15th. So March 15th is kind of like our first big tax deadline each year. And again, it's retrospective. So it's for the prior calendar year. C corps are due the same as the 1040s, as the individual deadline. So April 15th, again, give or take if there's a holiday or something. Right? So what tends to happen in the accounting profession, anyone that does tax work, is pretty much like early February through mid-April. It's a lot of chickens with their heads cut off running around, right? It's extremely busy. And if any of you experienced this, where you try to reach out to, let's say, your CPA or a tax professional during that period of time, sometimes your calls could fall on deaf ears, or it could take days or weeks to get a response. But that's just because the nature of the season. That's when a lot of these calls are happening. We have very hard deadlines to hit and not much buffer to deal with. Interestingly, a lot of countries have a longer grace period between when the calendar year ends and when their due dates are. Some countries, it's, for 2023, they don't have to file their returns until June or July. Some places even August, which is kind of counterintuitive because the US has one of the most complex set of tax regulations, but one of the shortest windows for filing the tax filings. Yeah, they should give a little bit more time. Now, good news, if someone needs additional time to file their tax returns, you could file an extension. There's no cost to this for an extra 6 months. So for S corps and partnership returns, if you file for an extension instead of March 15th, you'll have until September 15th. For individuals and C Corps, instead of April 15th, it could give you up until October 15th. So what happens is, given the number of clients, or just depending on circumstances, that file for an extension, we end up kind of having 2 tax seasons every year. There's the spring tax season that most people are familiar with, but then there's also like a slightly lesser fall tax season, which picks up usually in mid to late August and runs through mid-October. Even though with the extra time, sometimes the fall tax season can be a little bit more intense, just because those deadlines are hard deadlines. There is no an extension for an extension. Like, that's it, right? You hit the deadline or done for. Right? And you'd be subject to penalties and all kinds of other fun little things from the IRS. Now, when it comes to an extension, it's important to remember, it's very important to remember that it's an extension to file, not to pay. Now, there's still a common misnomer that if you file for an extension, oh, well, now I have another 6 months to pay. No. Whatever taxes were owed as of April 15th are still owed by April 15th. The other 6 months is just to kind of get your paperwork in order and make sure the filing is correct, right? Because if the whatever tax is not paid by the due date could be subject to underpayment penalties, right? So even if you file an extension, whatever is unpaid could be subject to a penalty of, I think it's 0.5% of whatever's owed per month, right? So it can add up pretty quick. Now, that's not as bad as failing to file and not paying. Fail to file, the penalty, I believe, is 5% per month, right? And again, every month it can just rack up. So, and we've seen situations where someone doesn't pay taxes for years for one reason or another. I mean, they're dealing with other things in life. Maybe they're dealing with getting their startup off the ground and it wasn't generating enough money. And they figured, they'll just kick that can down the road and deal with it later on. And when they finally do choose to deal with it, we found situations where a client that has maybe their base tax is they owe, say, $50,000, right, for years of not filing. But all the penalties and interest for years could be 2, 3, 4 times the actual tax owed. It's crazy how fast, and scary how fast that stuff could add up and compounds. Now, filing on time is, of course, absolutely important, but whether you file on time or not isn't necessarily going to dictate if you're selected for an audit, right? The audit selection process by the IRS, and the same thing goes with state taxing agencies, is largely random, right? There's you could do everything right in the world. You could always pay your taxes on time, never do anything sketchy or gray area or pushing the envelope, and still get audited, right? It's important to keep in mind that audits are not, they're annoying, right? But they're not that scary. As long as you're being transparent and honest with what's being reported, right? Then it's just a matter of just responding to the taxing authority or the auditor with whatever information they're asking for. Where audits can become scary is if someone is maybe forgetting to report all their income or over-reporting expenses, thereby underpaying their taxes. Because they will dig, and they'll dig and dig and dig until they kind of figure all that stuff out. Some things that can elevate that random component of being selected for audit would be if engaging in transactions that appear to be intended to avoid paying income tax, right? Doing everything in the world to, characterize things as, let's say, you hire somebody to do something for your business, but for them, they're like, oh, can you just say that you're gifting me the money, even though you're paying them income, right? So just so that they could make an argument that they're not reporting for the money you gave to them for whatever work was performed, right? That's definitely an avoidance scheme. Other things that kind of trigger or elevate the risk of an audit is when there's a mismatch in documentation. So as an employer, you have to issue copies of W-2s to the government as well as to the recipient. So that way, when each individual recipient files their tax returns, the taxing authorities will look at their copy and they'll look at the recipient and make sure that they're tying. Same thing goes with 1099s, K1s, and other documents. Everything is reported in duplicate or actually triplicate, right? A copy goes to the recipient, copy goes to the IRS, and another copy goes to the state, right? And they all check just to make sure those things everyone's reporting the same number, right? It's kind of like a cross check. And if there's a difference, right? If you tell the government that you paid a contractor $10,000 for a job, and then that same contractor on their return, they said that, no, I got $1,000, that's a flag, right? And the IRS will catch it and they'll request substantiating documentation, try to figure out why is there a mismatch. Occasionally, there could be a legitimate reason. Maybe a 1099 was issued to the individual, but should have gone to their company, right? Or vice versa. Another thing that can elevate the risk of an audit is when there's related examinations going on. So let's say you have two companies and one of the companies is undergoing an IRS audit. If there's similar ownership, there's a good chance the other company could be sucked into that same audit just because it's a related party. Same logic goes to, if you have an employee that has a company that's being audited, they might be audited. If you have a supplier or vendor that's being audited, anything that's 1 degree of separation apart, there's a decent chance that the scrutiny could leak over. Some other things that could trigger examination are failing to check specific boxes in the forms. So for going back to, I think this was maybe 2019 or so, IRS added a very discrete question on the tax filing saying, like, at any point in time during the year, did you have any digital currency, right? Or did you engage in any sort of digital asset transaction? And if someone selects no, but then they find later on via cross-checking, Coinbase or other providers out there that you did have an account, well, then again, it's kind of a mismatch, right? You acknowledge something that was untrue, right? And they're increasingly, I'm going to dig into this a little bit more, but they're increasingly doing a little bit more of that vetting, especially when it comes to digital assets, right? And it doesn't help when things like, what was the guy's name? Sam of FTX. I saw that he got sentenced to, it was like 20 years or 25 years or something like that. When those kind of things happen, or the Celsius bankruptcy, those kind of errors or hiccups in that industry just draw additional scrutiny across the board, right? So everyone in some way is under a little bit more of a microscope in that industry just because what a few bad apples may be doing. Right? There's the IRS doesn't necessarily rely on individuals to identify all the red flags that could be occurring. Part of what they do is leverage their automated system or DIF system, DIF, and some of their other technologies out there to flag things that could be an issue. Not that there's anything wrong, but it could be indicia of something wrong in the tax return. For example, let's say you have your sole proprietor. You have a Schedule C business, right? You'd be selling lemonade on the sidewalk. It could be running a personal training business on the side, whatever it is. And on your Schedule C, by the way, is kind of like an income statement for a small business, right? And it's part of someone's 1040 personal tax filing. And let's say on that Schedule C, they report $22,000 of income and then $5,000 of business expense for insurance and $4,000 business expense for advertising and $3,000 business expense for meals. The fact that those are all round numbers is very suspicious. And it's one of those kind of things that the diff system with the IRS would flag, because how often do we go out there in the world, to any vendor, Office Depot, Vons, Best Buy, whatever, and if you aggregate all of our transactions from a vendor for the course of a year, it adds up to a round number. The likelihood of that happening across many expense accounts is next to nil, right? So when individuals report a lot of round numbers, that could elevate their risk of an audit. It elevates their what they're showing on the computer system, right, with the IRS. And what happens is when their system identifies these things that could potentially be a flag, right, then additional scrutiny is done by a human being, right, in order to determine whether or not there should be an examination, right? But again, idea want to minimize those yellow flags and red flags, right, when preparing returns, and sometimes it's not avoidable, right? Sometimes things just happen to look suspicious, but they're absolutely legitimate, and that's okay, right? For example, someone actually could have exactly $5,000 of business expenses for meals. It's possible. It's unlikely, but it is absolutely possible that the numbers could work out that way, right? And that's okay. So it's good for the taxpayer to be aware of some of those potential flags. One, so they know, they're mindful of how they run their business going forward, but also in the off chance that they are selected for an audit, that it doesn't come as a complete surprise. A couple other ways that another way that sometimes someone be selected for an audit is if they're explicitly called out, right? Let's say someone is sued in a civil litigation matter or a commercial litigation matter, and during the course of that process, that the other party or one party, they find out that they're committing tax fraud, right? And there's a form out there you could submit, or individuals and companies could submit, reporting instances of known or suspected tax fraud or other illicit behaviors when it comes to tax compliance. Digital assets. So again, this is an area that is increasingly drawing a lot of scrutiny in the case of letters from the IRS, examinations, and even full-blown audits. One of the reasons why this continues to happen quite a bit, aside from what we hear in the news and read in the news, it's happening in the industry, is still kind of a misunderstanding about what constitutes a taxable event. So a taxable event is when something happens that can result or does result in tax, or something that is subject to tax, right? In the case of digital assets, there was at one point in time, there's a perspective that if someone traded, say, Bitcoin for Ethereum, it's not a taxable event, right? You're just swapping coins. And up until I think around 2017 or so, that was a somewhat common perspective, right? And then the IRS, came in and retroactively stated, no. Every single time someone trades a coin for a coin, taxable event. So any sort of built-in gain, capital gain or loss associated with each one of those taxable events needs to be reported. And we had clients that were doing 20,000, 50,000, 100,000 trades a year, thinking they didn't report anything. And also now they realize that, whoa, I have to report 100,000 transactions, right? Regardless of whether or not how much tax they owe. That's not the point. It's about the volume of activity, the nature of the activity. Another kind of misunderstanding with digital assets is capital gains or ordinary income. If someone is trading a coin for a coin, it's be subject to capital gains treatment, but it doesn't necessarily mean it'll be taxed at capital gains rates. Right? If someone buys a coin, holds it for a year or more, then trades it for another coin or sells it on the market or trades it back for fiat being just everyday dollars like USD, then that would be taxed at long-term capital gain rates, right? Which could be up to 20%. Capital gain rates are much better than ordinary income tax rates. The ordinary income tax rates, those brackets go up to, I think, around like 37 or so percent, which is a lot more than 20%, right? So there's an incentive for folks to report as much of their income as possible at capital gain rates, right? Long-term capital gain rates. If there's a capital transaction, like again, trading a coin for a coin, and they held that coin for less than a year before trading it, then it'd be deemed short-term capital gains, and short-term capital gains are taxed at ordinary income tax rates. So again, even if we're not talking about digital assets, anytime we're dealing with any sort of capital assets, right? Real estate, stocks, cryptocurrency, holding things for a year or more is almost always beneficial, right? From a tax perspective. Some other things that have been going on in that space is the taxing authorities increasing enforcement or seeking information from individuals. Back in 2021, they sent letters, 6173 letters and 6174 letters. They were essentially just saying, hey, taxpayer, we think or we know you've been engaging in digital asset transactions. Just a reminder, we know you better be reporting it. That's more or less what those said, but with a roundabout way, right? I usually refer to anything of that sort from the IRS as their love letters, right? And it's not the kind of love letters we like to get, right? No one wants a love letter from the IRS. They've also been increasing their number of subpoenas to various taxing or cryptocurrency exchanges, things like Coinbase, Binance, Kraken, all these platforms out there, asking these platforms to comply with their subpoenas by saying, tell us who's trading on your platform. Tell us how much they have in wallets on your platform. Right? Tell us what's going on, right? And then they'll cross-check that information to those individual taxpayers' returns, right? So huge red flag. If someone on their tax return says, nope, not doing anything with digital assets, but then they get the taxing authority has a subpoena from a platform, says, oh no, this person's traded 20 times and they have at least $50,000, they know that something is amiss and that the individual or the taxpayer is underreporting what they're actually doing. Now, because this industry has become a lot more mainstream, right, especially over the last 6-7 years, my firm and I, we've been pretty deep in the space for about 7 years now. The market has become riddled with lots of solutions, quote unquote. So there's a lot of software out there that claims to be able to provide the requisite analyses and forms for individuals to properly report their cryptocurrency transactions. One caveat with that though, is that one, not every software is created equally. Two, some are better at reporting some kinds of transactions versus others. Three, most of those softwares are built with a perspective of volume and limited types of interactions of being transpired. So, for example, if someone is trading, a few transactions or maybe a couple thousand transactions of just 2 coins on one platform. So when I say platform, I'm referring to things like a cryptocurrency exchange, like again, a Binance, a Coinbase, a Kraken, one of these places, one of these on-chain ecosystems. Then those softwares tend to work fine, right? Because what they're doing is they're referencing one connection. They're looking at kind of like one bank account or brokerage account in a way, right? And those ecosystems are very much kind of like a brokerage account, but for cryptocurrency in a manner. What happens with some folks where they start doing things off-chain, doing things, transactions directly from their personal wallets, or they're transferring a lot of things from one wallet to one platform, to another platform, to a different wallet, it gets very, very convoluted very fast. And we found a lot of those softwares out there tend to misreport the actual gains and losses. Right? So we encourage anyone that is in the space, especially if they're doing any sort of complex level or high volume level of activity in the digital asset space, to not rely so much on maybe a single source, like a single software solution, and to leverage a professional out there to actually, at least from a high level, look at it. Because what happens if someone misreports and then the IRS, let's say, audits them? Oh, look, we looked at your stuff and we found that, you underreported $100,000 of capital gains, and here's some penalties and interest. The taxpayer may be incentivized to say, whoa. No, use this software. It's designed for it. Well, the kicker is, if you look at that fine print, the very bottom, for a lot of these solutions out there, it says, do not rely on this as tax advice. This is not tax advice. Consult a professional, right? It's their disclaimer, right? Because it's just a tool. And unless you know how the tool works and you're using it the right way, then you get not necessarily, can be completely reliable. So just keep that in mind. Also note that, let's say I talked a little bit about trading, mining. If someone is mining coins, that every single time they mine a coin, it's ordinary income. It's almost, think of it kind of like interest. You're getting paid interest for doing something, which is taxed at ordinary income tax rates. So let's say someone mines 0.1 Ethereum. So they'd have 0.1 value of which is 3,000 something dollars. We'll call it $300. They have $300 of essentially kind of like interest income in a way, tax or ordinary income tax rates. And then let's say they hold that fraction of a coin for a little over a year, and then they trade it for something else. That subsequent trade would be subject to capital gains, right? Long-term capital gains. So it's kind of like two transactions in a way. When you first mine it, it's ordinary income. Then with the next thing you do with it, when you trade it, then that's a different transaction, two taxable events. Now let's get into some tax strategies, ways to minimize your personal and or business taxes. Some low-hanging fruit. I'm breaking this up into two buckets. This first slide is more the lower hanging fruit as accessible to more individuals. And then the second slide in this section tends to be a little bit more like advanced strategies type stuff. First and foremost, we contribute to a retirement plan. Right? Generally, depending on the type of retirement plan, whatever you contribute there is tax deferred. Right? So say $5,000 goes into a retirement plan. Well, you just reduced your taxable income by $5,000 for the current year. And you're kicking off having to report the corresponding taxes or pay that corresponding taxes until you actually retire. So the further out that is, the more advantageous those contributions are. That's why someone that's contributing fully to retirement plans in their early 20s are maximizing, right, what they are deferring, right, or maximizing their tax advantage using that strategy, right? The longer you defer, the more valuable that strategy is. So contribute to your retirement plans as early as possible, as regularly as possible, as much as possible. If you're self-employed, be sure to write off all the legitimate business deductions. Keyword here, legitimate. It's not just creating additional business deductions just so you end up having like no tax out kind of thing. I've seen that, sadly enough. What's kind of funny is, we had this KYC process with, prospective clients, knowing your client. And usually at this point, I think we can usually tell almost right up front whether or not the client is somebody we want to work with, or someone that's more interested in just like doing pay to play. Like, oh well, what if how can we reduce my business taxes here? There's like $40,000 of profit. How can we get that down to 20? Can we say that I contributed $10,000 for new machinery? I'm like, what do you mean say? I mean, did you actually do that? Well, no, but can we say that? Like, oh, no, you can't just make up expenses. But they do. Sadly enough, there are individuals that do. And even worse, there are tax advisors out there that go along with that. That's a strategy that they play, right? Now, you pay me a little bit more, I'll make sure you owe no tax, right? Or I'll guarantee you a refund, right? Just pay me an extra 5,000, right? It does happen. But writing off the legitimate business deductions. So not everyone is an accountant. I get that, right? And so it's not uncommon for business owners, especially for startup businesses, where maybe they don't have the most organized business books. In fact, maybe there's no business books at all. Sometimes it's just they're paying for things from personal credit cards and the business credit card, and they, at the end of the year, they have no idea what the profit was. They know that they made money because there's cash in the bank and they're able to pay their expenses, but they don't know how much. And therefore they also don't know what their business deductions were. So by this point, I mean, just making sure that we're not missing legitimate business deductions. Again, if they're using their personal card for some business stuff, make sure those things are identified and factored into the financials used for their business. Next one, taking advantage of specialty credits, like for solar or electric vehicles. And those are just a couple of many examples out there. There's also tax credits related to tuition. There's tax credits for all manner of things, right? Just keep in mind of doing anything that you think there might be tax credit for. Sometimes a quick Google will give the answer, or check with your tax advisor. Purchase a personal residence. If you don't have a primary personal residence, itemizing deductions. The standard everyone gets a standard deduction, which is, I forget what it is offhand, 12,000 plus per individual. If you itemize deductions, it could be a lot more than that. And usually it is, especially in places like California. Because if you itemize deductions and you own a primary residence, right, so it could be a condo, it could be a single family home, duplex, whatever that you live in, you could write off the interest associated with the mortgage, the property taxes, then those things can add up pretty quickly to be a lot more than what the standard deduction would be. Itemizing deductions on Schedule A also allows for things like charitable contributions, right? You give a bunch of things to Salvation Army, Goodwill. You give a donation to various funds and other nonprofits out there. Those are all deductible if you itemize. If you do not itemize, then generally those aren't going to be of value. Other than, of course, you're still paying it forward, right? You're still contributing to the betterment of society, right? So not discounting that piece at all, but just from a tax perspective, there's really no value in those unless you're itemizing generally. Now, some more advanced ways to mitigate taxes. The 1098T, that's related to tuition that's paid. So if you get a 1098T, that's whether or not you take the deduction or the credit depends on your individual tax circumstances. Quick tangent. A tax credit is generally a lot better than a tax deduction. Well, Jeff, what's the difference? A tax credit is a dollar for dollar reduction of the taxes owed. So let's say for the year you have $10,000 in taxes that are owed, and you get a tax credit for $1,000. Well, now your taxes are $9,000. Conversely, let's say it's a deduction. You owe $10,000 in tax and you have $1,000 tax deduction. as $1,000 tax deduction from your taxable income. And let's say that you're in a 30% tax bracket. So that $1,000 tax deduction is really just $300 in tax savings. So in this hypothetical, $1,000 tax credit will bring your obligation from $10,000 to $9,000. That $1,000 tax deduction would bring your taxes from $10,000 to $9,700. Okay, so credits better than deductions. I'll go through these ones a little quick because they could get a little weighty if we get into them. Leverage QSBS. Now, this is absolutely kind of a more advanced thing. It has to do with oftentimes if you're entrepreneur or a serial entrepreneur, but I think pointing this out could kind of helps paint the picture of like why the ultra wealthy can effectively pay so little tax. And it's because of things like this. QSBS is a qualified small business stock. It is a mechanism in place that encourages investors, entrepreneurs, individuals, partners to invest in small businesses, to take stock in a small business. The way it generally works, and there's a lot of rules about how it works and exemptions and stuff, so it doesn't work for all industries. But generally speaking, if you have small business stock in an entity that this qualifies for, and it usually means it's less than 50 million, right? So if the business is worth, it's less than 50 million in assets, usually it could qualify if it checks some other boxes. And you hold that stock for 5 years, and then you sell it for a gain, you pay no tax. So let's say someone has the stock that qualifies for this. They hold it for 5 years and they sell it, and there's $5 million of capital gains. All right, at 20%, it'd be $1 million of tax just for the IRS. $1 million in tax. Because of this, pay zero. Not bad, right? And there's a lot of things out there like that, right? Another one, this one's a little bit more, I'd say, accessible, the Augusta rule. If let's say you have a business and you legitimately use your residence, primary residence, for, let's say, team meetings or a company retreat, right? You have everyone come over and you have like some seminars and camaraderie and some exercises and stuff. And the business rents your residence for you at fair market rates, right? Whatever that is, $500 a day, $1,000 a day. The money you get from the business, you don't have to report as income. The business, however, still gets a deduction. So you get to have your cake and eat it too. Not bad. Now there's limits to that. I think you can use it up to 10 or 12 days total per year. But the kicker for this, though, and where it's most often is abused, is people they say they're doing it, but these meetings or events that they're being rented out to their residents never actually happen. So anytime we have clients that are looking to leverage that rule, they make sure, okay, take pictures of the event, make sure you have an invoice or invoices, make sure you show them that it's being paid. If you had catering or something like that, save those receipts. Like, just make it sure it's very well documented that the event actually occurred, right? Timing of business expenses. So again, this is something if you're self-employed in one degree or another. If you have, let's say you have a really great 2024, amazing. You started up your business 5 years ago, and now it's really taking off. Whatever it is, graphic design, consulting, e-commerce, whatever. And you're like, oh, wow, this is a really good year, but oh man, I'm going to pay a lot in tax. And let's say it's, November, give or take. One thing, and let's also say that you file your taxes on a cash basis. And so right now there's like a lot of money just sitting in the business bank account. As a business owner, you could do is maybe fast track some of your expenses. So let's say 2025, you were going to buy 4 new computers, you're going to buy a new copy machine, you're going to buy a whole bunch of new brochures and all that kind of stuff, and you were going to wait until February to do it, maybe do it in December, right? So you can minimize your expenses, your taxes for the current year. Now, there's the trade-off though, right? Because if you fast track those expenses, then what you're doing is you're taking away those deductions from a subsequent year, right? But sometimes it's worth it, right? It's worth to have a little bit more money in your pocket longer. Another thing individuals can assess is adjusting their tax residency. Now, there's no question California is amazing in many, many respects, except maybe when it comes to cost of living. It's pricey. It's very pricey to live here. And not just here in SoCal or up in the Bay Area, but I mean, throughout the state, as a whole, it's very expensive. And given the tax rates we have here, it's also very expensive, right? So occasionally some of our clients will reassess whether or not being domiciled here makes sense. We've had some of them leave and go to places like Texas and Florida and Wyoming, and places that have either no state income tax or much lower state income tax. And they'll often do that when they're expecting, and the forthcoming years, maybe a large influx of cash, right? Maybe they're looking to sell their business in 5 years, right? Or they're be coming into some substantial stock sales in a few years. Not having to pay that 10 to 13% in California can be a substantial sum of money, and could be worth it to move elsewhere. Same logic applies to timing of capital gains, right? If someone's looking at maybe making quite a bit of money in, say, December for selling some stock or cryptocurrency, if they don't want to necessarily take that hit in the current year, and they don't think the market is going to shift between then and early January, maybe they'll hold off on executing those transactions until after the new year, right? Just again, kind of put off that exposure, those taxes to the next year. So I'd say the takeaway here, aside from making sure you file your taxes by April 15th, is refer to a professional as needed, right? Even if it's just for a few minutes, peace of mind. Make sure everything you do is on the up and up. Make sure you're taking business deductions that are legitimate. Make sure you maintain documentation and all these other fun things that I know most of us don't want to do unless you are an accountant, right? But that's what we're here for. You're always welcome to reach out to myself, and there's other colleagues of mine here at the university you're welcome to reach out to. And on this last slide, they have some of my contact information. So I'll leave it. I think we have about 5 minutes or so left. I meant to leave a little bit more, but if you have any questions, feel free to raise them now.